Hey everybody and welcome back to Dollars and Cents, helping you make sense of making dollars. Today, we will be talking about my thoughts on investing in growth companies, which make up about 20% of my portfolio, and is my second favorite part of my two-part portfolio. First, what is growth investing? It's investing that leans more towards innovative, rapidly growing companies. This includes Apple, Amazon, and a personal favorite of mine, CrowdStrike, a cloud-based data security company. These companies, though, are often volatile and have large price swings that react more violently to larger market events, such as a crash or a correction. Their volatile nature is the reason why they make up such a small portion of my overall portfolio. They are a riskier investment. Growth stocks, such as these, also typically don't pay a dividend because they utilize all of the capital they gain to further grow their business. However, my reasoning for including them anyway is this. These companies often have incredible market-beating returns. If we compare, for example, Apple and Amazon to companies that focus more on paying dividends, like 3M and AT&T, over a 10-year time period, these high-growth companies generally beat the returns of those who don't pay out dividends. Apple has a 32.79% annual growth rate, and Amazon has a nearly identical 32.72%. On the other hand, 3M only has a 9.54% annual growth rate, and AT&T has a 5.88% growth rate. It looks like there's a clear winner between these two options, right? However, if we could rewind 10 years, the winner might just appear differently. If you were given a choice 10 years ago between a fairly young, largely untested, and less stable high-growth company like Amazon, and a proven, established, stable materials company like 3M, which would you choose? We now know what Amazon has become, but back then we couldn't be sure if it would survive, let alone grow into the multi-billion-dollar company it is today. For me, it's most likely I would have chosen 3M, not Amazon. When I choose a high-growth stock to invest in, I typically look for companies that have displayed a record of growth, and what I believe can sustain that growth. Take a look at what Peter Lynch, one of the most successful premier investors of our time, said in retrospect about Walmart when it went public in 1970 to its growth in 1994.
Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 it went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states, you keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could wait 3 years after Microsoft went public and made 10 times your money.
Walmart at the time was seen, I imagine, much like Amazon was 10 years ago. A high-growth company with a somewhat uncertain future. Of course, I'm in no rush to invest in speculative companies like Amazon was or Walmart had been decades ago. Speculation is certainly still part of my portfolio. I will only invest, though, if I feel great conviction for a particular company, like CrowdStrike, that data security company I had mentioned earlier. CrowdStrike already has what I believe is an impressive product and shows promising growth at a tremendous rate. In my portfolio, this company is my favorite, and I hope to make it my largest holding for high-growth companies. I really do believe CrowdStrike could be a $100 billion market cap company. Just look at their growth from 2019 to 2020. It went from being a $10 billion company to a nearly $50 billion company in 1 year. With more companies using cloud-based services, CrowdStrike's security products are needed now more than ever, and it's certainly rising to the challenge and demand. A company I haven't mentioned yet in this video is Orchard Therapeutics, a London-based company that develops treatments for rare inherited diseases, like this one or this. No, I won't even try and pronounce them. Orchard Therapeutics is another speculative company in my portfolio. My reason for investing in this company is rather simple. I think their developments can be the future of medical treatments and lead to breakthroughs in medical science. If you want to check them out for yourself, I've included the link in my description. Now, I do want to mention that it's possible that these companies, such as CrowdStrike and Orchard Therapeutics, might end up not working out for whatever reason. They are high-risk, high-reward companies, and they might not reward the investment in the future. In those times, you just need to move on. Don't get hung up on the loss of that investment and sell out what you have invested if you believe it'll only cost you your hard-earned dollars. We like keeping our hard-earned dollars. We'd like them to make sense for our financial future. And as always, I am no expert. I just want to give my thoughts on investing and take you along for the journey, in the hope you might learn something too. Or, at the very least, learn from my mistakes. If you want to join me on this journey, go ahead and like this video and subscribe. And as always, I hope to see all of you in the next episode of Dollars and Cents.